Thank you all for coming to the Debt Capital Markets panel. My name is Zach Holderman. I'm with CBRE's U.S. Healthcare Capital Markets Group, focusing on debt and structured finance. I have the pleasure of moderating this year. We got about an hour and 15 minutes to go through some topics, and admittedly, a handful of those topics could fill an entire hour. So we're going to try to be efficient with our time, leave a little bit of time at the end for Q&A. As I was thinking about this little intro speech, it hit me, normal course of my day, my business is rolling out of the gym or walking the dog or running the dog is check the headline news. And I think it's something that we're all experiencing and doing as a part of our day, right? And there's a lot of noise in the system, both domestically and internationally, that has an impact in our space, and most certainly, escalating jabs between the White House and the Fed. We've now got our judicial system involved. The coincidental tumult, international tumult, most notably with the Japan bond market. There's a lot of noise, right? But we're really here to talk about this part of our industry, healthcare lending, specifically what we're seeing in real time and what we see evolving throughout the year. I've got a great group of panelists, lenders, competitors, friends. We had all of the above, all included. Their own experience, their own expertise, their own transaction volume. We're going to be brief with the introductions to allow time for the actual discussion. There's an enhanced bio I'm sure y'all can read, but we all know each other. So I'm going to ask my panelists to do a brief introduction of themselves, who they're with. We think it'd be useful information for all of you to hear volumes for last year, as well as how the year started off and what we feel like it's going to look like for 26. And then something fun, we thought it'd be interesting to talk about one of the more unique deals that these folks completed last year. So with that, I'll stop talking and hand it off to my friend, Steve.
Excellent. Good afternoon. My name is Steve Reedy. I'm head of medical office banking with First Citizens Bank. We are very active in the medical outpatient finance business. We put about $750 million to work last year. We've been doing this very consistently for about a dozen years now. And what was the other question?
How's the year started off? How are you feeling?
2025, had a little bit of a slow start to it, but certainly picked up in the second, third, and fourth quarters, and that has carried forward into the first quarter of 26. So things are going well.
And that 750 you mentioned, you're going to do more this year, optimally?
I think if we do about the same, we'll be hitting our targets.
Great. And the most interesting or unique deal that you closed in a couple sentences?
So, I think we've done a lot of deals. We do everything from portfolio financing in the $100+ million context to single asset financing to construction loans. So, I don't know that I love one more than the other, but we're definitely a full service lender that's there to provide all the products.
Great. John, why don't you go last? We'll skip over you and stick with the lenders here real quick, and then
just because we're competitors. Okay.
Yeah, we'll create plenty of time for you.
Go right ahead, Winston.
Hi, Winston Abbott. I'm with Siemens Financial Services out of Dallas, and we're the finance arm, part of Siemens AG overseas. We've been in this segment for probably a good 20 years. Obviously, we're all friends and competitors. We also work together. As far as volume, I always hesitate on that because these guys do bigger numbers, but we do about 500 million or so, plus or minus. But again, we participate and do a lot of direct transactions as well. Interesting deals. I think we do a lot of one-off transactions, so there's quite a few. But probably one that sticks out is we're doing a federally qualified health center, so we're doing a little bit more of that. It's like kind of a renovation, re-tenanting of the building in a growing area. So it's kind of a credit that a lot of people typically don't look at, but I think it's been successful for ourselves and the sponsor. So Eric?
Good afternoon, Eric Tollefson. I work at Capital One. I'm Senior Managing Director, Head of Healthcare Lending. Last year with respect to healthcare real estate, we did about $7.5 billion, and we held about $5 billion of that, so 7.5 gross, 5 net. For 2025 or 2026, relatively hot start. For us, partially because a fair amount of deals moved over from December to January. I don't know for a fact, but it seems like there wasn't any tax stuff or anything that really encouraged folks to make sure it happened in 25. So we had a fair amount of deals that we had anticipated closing in the fourth quarter that are now going to close in the first quarter, which is, never a problem. I think excited about that and hopeful that this conference spurs more new transactions like it has in the past. I think that'll be great. With respect to the more interesting deal, we did a relatively large transaction with Remedy Kane and Welltower. So there was a press release on it, so I'm not straying away from that. Selznick, if you're looking. And so that was, for my estimation, again, just me, that was one of the larger deals in the medical office world. It was about $7 billion in terms of acquisition, and we were the bank debt piece that was about $4 billion. So Capital One was lead left agent. We held about $1.2 billion at close, and then to the right of us was Truist BMO, Ally, and JP Morgan. So pretty pleased with that one. Looking forward to another one. As that compares across, and this is dating myself, in 2008-ish, we did what I thought was the largest MOB transaction. It was $130 million to ARC. So things have gotten bigger. So $130 million to $7 billion. So,
John, if you would.
John Nero, head of healthcare debt at Newmark Healthcare Capital Markets. Always hard to follow Eric on a transaction volume metric, but I do win the award for oldest headshot. So how that got going for me.
I'm not too far behind you.
We had a great year last year, historic volume year for us. We did about $4.3 billion in transaction volume across investment sales, equity, and debt. Debt represented about half of that, so it's about $2.1 billion. We're an advisor, not an originator, so we advise clients borrowing in the sector. And in terms of probably most interesting deal from my perspective, at the end of last year, we advised IRA Capital, which formed a new joint venture partnership with CPPIB and GIC in their acquisition of two portfolios from Healthcare Realty Trust. Eric was involved in that transaction. It was a club deal between BMO and Capital One, with a small participation by Old National Bank. That was about a $700 million loan, inclusive of the accordion feature, which has now started to get tapped into on some future acquisitions. So from my perspective, it was interesting, given the new joint venture borrower that we stood up in that transaction, but also just the fact that we saw a clear return of portfolio transaction activity, particularly in the second half of last year, and that deal is really indicative of that trend. So.
Yeah, thank you. I think it's natural and perfect segue into the nature and status of the portfolio financing environment, the portfolios that we're working on that are coming to market, and deliberately ET and your business in the portfolio side. It'd be great to just hear a little bit more about what we're seeing. I think talking the conversation last year, I recall, John, when you were moderating the panel, was syndication risk.
Yeah.
And I'd love to, at that point, for context, this time last year we were about $150 million was the general consensus from those large deployers of debt capital. In the fall, again for context of the previous year, was about $75 million, where we would tell our clients that there was syndication risk, and not that it wasn't doable, but that those best efforts clauses would appear in applications, and ET would probably argue with me, but that was the general market sentiment from Threshold. So I'd like to maybe stop right there, maybe work our way back down the line, ET, since you did lead left that transaction. Maybe talk about where you see that threshold to be today. Is it 300? Is it 500? Is it, and then the post-closing sell down or syndication market? Let's touch on that a little bit.
Sure, great question. Syndication has been pretty active in medical office the last 5 or 6 years, I think. Prior to that, maybe not so much. So during that time, we really built out what I consider a pretty large syndication platform. If you were to look at the deals we sold on the medical office side last year, we would be the number 9 bank for league tables for all commercial real estate. So that's just our medical office piece. So syndication has really been a part of what we do, and that kind of correlates with the larger portfolios that are available today. When you talk about at what level we syndicate, that largely depends on the deal, just like everything else. But to give you numbers, absent a big concentration risk, a couple few $100 million is probably a good starting place. And then we are okay generally taking to do a post-close syndication where we take the syndication risk up the chain. We don't really have a number where we stop doing that. Often it's the borrower's choice of how they want to handle it. So that's usually the way we look at it. The largest we've ever held was the transaction I mentioned. That was 1.2 billion, but I think typically we agent them and we hold between 60 and 70% of each of the transactions. And we are very happy doing it either way, a club close or doing it where we take the syndication risk and use our platform to syndicate.
Well, we're much smaller, obviously. But we've teamed up with Eric. A lot of times we will provide a small segment, which I think helps a little bit. But I think from the general consensus is that, probably 3 or 4 years ago, our average ticket was probably 15, 20 million. And I know it doesn't match up to these numbers, but we're probably 35 to 50 on a hold. We'll do a few small portfolios ourselves, but to be honest, often we look to be a participant, with Eric and Steve and others in the market. And we're kind of content that way, and that's how we've been able to execute together. So,
I think from our perspective, Zach, I agree. I mean, we talked in 25 about prior year 24 activity, and the 2 years preceding last year's conference, I think smaller was clearly better from a borrower standpoint. I think you had to be strategic and pick your spots. There was a clear lender hold limit. Although it varied, I would say it did not line up with larger portfolio transaction volumes in terms of the required financing to put those deals together. 2025, we saw a notable shift and improvement in that dynamic. And I think it was a clear communication from lenders, particularly in the second half of the year, that bigger was better. They were showing preference for scale with the right sponsors and the right deals, of course, but bigger started to become better. And we saw that translate in terms to the borrowers behind those, whether they were refinancings or portfolio recaps or acquisitions. We saw clear, I think, premium on spreads. We saw better execution terms all around. And so what we haven't seen yet is a clear quantifiable cap rate premium come back to the portfolio market on those trades. I do personally think that's in store for 2026 and beyond. Just when you look at the spread between interest rate and cap rate on some of these prints, it's the widest it's been in a long time. So that, to me, screams the opportunity for some cap rate compression. But certainly from a borrower standpoint and financing standpoint, I could make the case quantifiably there was a borrower premium for portfolios last year.
Yeah, our appetite for portfolio financing has, continued to be there. We've really focused over the last several years on building out our syndication desk, and we are actively taking underwriting risk and syndicating on a post-close basis. That said, we're not only focused on portfolio financing. We are still very active in the single asset category, as well as the construction lending.
And I think it's, and John, I think you said it, and I may able to repeat it in a little different way, but the portfolio aggregation strategy obviously has proven itself well in our business. I think there's been a desire to have more of that action occurring. Obviously, it's been a difficult capital markets environment for all of us. It's nice. It's brilliant to have a large transaction in our rear view. And I think, 1 or 2 more of those will really effectuate that compression between the pricing of those portfolios. There's been a discussion in our camp, and I'm sure with all of you, relative to the configuration of those portfolios, consistency, and what you can get away with putting in a portfolio right now that is financeable in a very efficient way. But I'd like to take the conversation just very briefly in a little different direction relative to equity deployment. There's been a handful of new marriages arranged, to a degree that's bled into 2026, and so. Some of these institutions need to put out big checks, and the portfolios of size and substance are needed really to get that going. So I don't know if I heard a clear answer. Are we saying $300 million is kind of a comfortable number to where folks are feeling like there's no best efforts clauses in these applications, or is it more?
I think that feels like a good loan amount number to capture the maximum level of interest between, the middle market banks will stretch and try to look at a full hold on that amount. If not, it maybe takes one participant to get it done. And certainly for the national names, many of whom are on the stage, that's a comfortable amount we've seen historically over the last 6 months be a hold limit they're comfortable with. So, I think it's probably 2 to 3x what we were telling borrowers to aim for this time last year. So very notable uptick.
I think for my part of the world, north of 200 is probably when we start syndicating absent a concentration risk, and we're happy going up the line to take the syndication risk. There's no, there's no number where we have to club it. We can generally figure it out.
And are you feeling like it's is it at that level, just as an example, in a good clean portfolio? Is it a 3-bank syndication, 2-bank syndication? I mean, we'd all like it to be less, but are you feeling like or is it the demand there to where you're feeding a couple of different folks through a larger transaction?
It really depends on how it evolves. I mean, we've done enough, we have enough experience with it, and we have enough of a list of banks that are interested where we generally do it. I think for the borrower and the agent, it's easier with fewer, but we're very happy to see how it plays out. Often the borrower may have banks that they want included, and we're happy to include them. So I don't know that we really limit it by number of banks. It's more how the transactions evolve. But in general, bigger is better, and the fewer cooks in the kitchen is a little trite, but probably an appropriate cliche.
Right. And you've got, you named some folks that aren't conventional, usual lenders in our space that participate in large financing. Maybe Steve, I'll ask you this question. We're often asked new lenders in the space, right? Are you seeing new participants? Are you seeing a larger demand from some of the folks that have participated a little bit more sporadically in the past? What's your sense?
I mean, over the last 2 years, certainly we've added some participant banks to our stable that have not been there previously. We're continuing to show opportunities to other local and regional banks that do have an appetite for the space. Some of them we're transacting with. Some of them are still coming up the learning curve. But yeah, there's definitely more interest in the space, and it's going to support a stronger syndication market going forward.
I would agree with Steve. I think there is certainly more interest in the space. I think folks with and I don't work in any of these places, so I don't know, but from a third-party perspective, it feels like folks with a limited amount of loan dollars they can allocate to one transaction, it may feel better from a credit size to take a piece of a larger diversified cross portfolio than to do a one or two, a single or a double, right? So I think that's of import. I also feel like often, not always, I think the prevailing sentiment is folks want to do more in the syndication space. I think when there are banks you don't typically see, that's often sponsor dependent. Not always, but they often come with a sponsor.
I was just about to say that same point, and I think with the new equity we're seeing come into the space, in particular, some of the offshore names from Canada, Middle East, Asia, you're going to see more lenders, particularly money center banks and institutional lenders, follow those sponsors. They're not lending in medical office necessarily as a matter of course in terms of their strategy, but they are sponsor driven, and they're going to follow those sponsors to the right deals. And so we're starting to see that, particularly in the second half of last year. Saw names like CIBC, Morgan Stanley, some of the bigger money centers that are just focused on sponsor relationships in the sector. But I will say they've taken the time to study the sector. They understand the fundamentals, and I think they see it as an attractive collateral pool for their book. So I do think we'll see more of that. I would also say we're a heavily bank-driven market, right? I mean, in any given year, it's probably 70 to 80% of originations across the sector. But last year we did see an uptick in LifeCo lending activity. We closed 3 LifeCo loans on our book last year, and I think it's not necessarily a theme I expect to accelerate in 2026, but stay steady. There's borrowers that are looking at lower leverage options, longer term duration paper. It doesn't always line up as well with the bank market, and there is a depth to the LifeCo market that we saw a notable uptick in last year.
Yeah, it'll certainly become much more of an interesting conversation, pending what happens with, the Fed this year. Obviously, dropping that 10-year below 4, more closely aligns the cost of capital between the banks. I still think there's a pretty good amount of headroom, as we all know, relative to bank financing. And it's been a shorter duration cycle of investing for our space. But I would agree we're seeing an uptick in LifeCo interest in medical outpatient, and the white papers that we all helped them write and other equity investors write 3, 4, 5 years ago are now starting to come to fruition. So it's feeling like the depth of market's becoming a little more fruitful. Thinking about, where, and John, I think it's a perfect spot for you to start in on, and then we can work our way down. But the thematic changes in our business, right? At a basic level, folks want to understand where leverage points are. What are you're telling your clients and sentiments on lender spreads, cost of capital, structure. What are some major thematic things that you're seeing in the market right now?
Well, I think we saw a lot more 70% LTV deals get done comfortably last year than certainly the prior 2 or 3 years, where 65% felt like the high water mark. I think many on the stage here will agree it wasn't a function of capping leverage at 65, but it was DSCR primarily driven, where deals were not penciling at a higher leverage point than, call it 65, 67%. We saw a lot more 70% loans pencil comfortably. We got a few 75% LTV executions done, whether it required note on note or stretch senior structure. Those were still getting done. So one, I would say higher leverage, comfortably penciling. 2, tighter spreads, which does help, I think, depending on the sizing math that's employed. We saw spreads on the corest of core deals in the kind of mid 100s. That was a notable decrease from where we saw pricing this time last year, which I think was upper 100 range. You could probably argue a 30 to 40 bip decrease in spreads on core, and I think that same spread decline was noted in core plus and certain value add execution. So pricing improved. With that, we saw stability and a decline in the indices that also compounded interest rate decline. So all in all, pricing improved. Availability of IO was already pretty good, but I think that maintained and was pretty steady. And then, I think just some of the structural points around things like deposits were not as much of a focal point. There were still banks that wanted to see a path to a larger relationship, as I'm sure is important to everyone on this stage, but it wasn't front and center in the first conversation on a request like it was throughout 23 and 24. I spent a lot more time than I ever hoped and imagined learning about treasury relationships in 2023, and I'm glad those days are a little bit behind us from a rear view standpoint. That is still dynamic for some, but it's subsided dramatically, which I think is good.
Yeah, I would add to John's point, I think we're one of the few non-bank lenders in the space. So over the years, we haven't had the restrictions of having to have deposits or operating accounts. So I think that's helped us a little bit. We also have a little bit more flexibility with regards to regulations, not again being a bank entity. So I think we've been able to kind of flex on structure a little bit. I know interest only is an important factor in the market. I think to John's point, I think we're doing some 70. We've probably actually done some 75% lever transactions, even with a few non-investment grade credits. So we're starting to, I think, get back to, I'm not going to say where we were 3-4 years ago, where we were doing 5 years of IO at 75% loan to value, and I do have my risk people here, so I have to be careful what I say. Don't want them falling off the chair, but we are starting to kind of widen the box a little bit more from our perspective.
Yeah, I would definitely agree with the leverage moving up, and to John's very good point, the dynamic is more just a function of math, right? It's if it covers 1 1/4 as if amort. Historically, we have been in the 70, touching 75 range, and my overriding preference is a little bit high. We generally like the risk in medical office, and all things being equal, I would prefer higher leverage and get paid a little more than lower leverage. Yeah. And in general, IO has not been a problem. So we'll see how the math plays out, but it would not be a problem for me if it came back to a market where 70 was kind of the typical position, with some stretching to 75 and 65 was considered lower leverage. I think that'd be great.
No, I feel like we're headed there. That's what we're seeing in the marketplace right now. It's definitely been a dynamic change over the last year to revert back up to 70, and 65 is becoming a lower leverage point in the marketplace today.
Yeah. And with regard to in contemplating the maturities that are coming up, and we recognize you've got robust books of business and client base, but as you think about 2026 and in a year, maybe following some years where there's been pay downs or extensions, are you feeling like that's a comfortable position with the book of business relative to what's coming to maturity this year? Maybe not a trade, maybe a refi versus a trade, because the math's starting to work a little bit better?
Yeah, I mean, we have great comfort with the debt maturities that are coming due within our book in 2026. And we've gone through the book on a quarter-by-quarter basis, and we feel very comfortable that that's all refinanceable and or going to actually stimulate, it depends on where the fund is in its life. It's going to stimulate some investment sales activity as well in the marketplace, just with the number of debt maturities that are coming due in 2026.
Yeah, I mean, I can't speak to a book per se and what's maturing this year, but what I can say is 25 was a record year for us on debt origination or debt brokerage. The second largest year for us was 2021. And if you think about how much 5-year money got put in place in 2021, whether it was 3 years with a couple extension options or 5-year flat terms, we're expecting to see a pretty significant wave of refi activity for our book this year. What'll be interesting to see is how much of that is refied at par versus paying cash neutral versus cash in deals. But I do think, generally speaking, this is where the resiliency of this sector really shines. And I think there's going to be a market to take that debt out. And it does help that we're able to see higher LTVs penciling again to make up for what could be a shortfall in proceeds.
Yeah, I think our portfolio, we manage it pretty closely. We use runoff and pay downs and use a little bit of excess cash from the corporate level. So we do monitor it pretty closely. I do see potential of some more refinancings coming up. Also, I guess what that gap is as far as what they can refinance at versus where we are, to John's point, if maybe it's some more cash out that allows you to keep the assets on the books, but we do anticipate to see a little bit more runoff than normal. Obviously, for you borrowers out there, it's a great market. Spreads are getting compressed. Not as great for some of us up here, but we're trying to kind of manage through that, and I think we are going to see a little bit more of that happen in the market.
Absolutely. I think we have more maturities this year than we have had typically. I think largely a function of robust originations in 2021. I think ours probably mirrored John's. The past year was probably our largest. The one next to that would have been 2021. And I think also some carryover from 2018 and 2019, where maybe they got a year extension, 2 years extension. And now I think folks are more comfortable with deciding what they're going to do with their asset or assets long term. So feel really good about it. The goal is always debt neutral or possibly give more proceeds. So yeah. I think we feel pretty good about that eventuality.
I mean, I think Winston, you made the comment about cash out. We did one transaction with a significant cash out last year that had a good rationale, but probably not there in the market yet with the value creation and where the attachment points are currently relative to the refinance market. But I do agree that it's going to come back into the purview and be a part of the discussion. Maybe a good moment in time to stop and think about, and I think Winston, on a pre-call, you made a comment with regard to where you're finding your sweet spot relative to where you're pricing your capital and the size of the checks that you write. I'd love to maybe have you start off with inpatient rehab. I know you mentioned the FHQC, but what's your profile? What are you looking at right now?
Yeah, I think we obviously do the traditional MOBs, et cetera, but we do a lot of post-acute out in there. We do a lot of inpatient rehab. We still stick with some of the asset class that's been around for a while. The freestanding EDs, believe it or not, some of those are starting to come back in a little bit different credit structure. We're doing the micro hospitals I mentioned earlier, federally qualified health centers. We're doing some VA clinics. So finding some different spots that maybe aren't traditional to the larger portfolios. We're also dealing, as you mentioned earlier, there's new equity partners coming into the market, smaller regional players that only need 1 or 2 deals a year, something that's a fit there. So again, with our balance sheet, the average deal, 20, 30, 40 million, that's a good fit for that as well. And the one thing we'll touch on a little bit further, the conversation on the construction front, and just from what we've been experiencing, I would say probably 3-4 years ago, it was all probably 75% was refi acquisition. We've kind of flipped the switch here this last 12 months or so. About 75% of what we're doing is construction. So I know there was an earlier presentation, as far as supply coming up. I don't know, maybe we're just fortunate, but we're finding a lot of the developers out there that have landed deals that they've been working on with hospital systems. Literally, the 2 that we're doing right now, believe it or not, one's been in motion for almost 6 years, the other for 7 years. So these developers have had the land. They've been waiting for the hospital system to capture that market share. Now they're coming to execute. So we are starting to see more of that, and that's taken up a little bit more of our underwriting capability. So
Steve, you want to touch on?
Yeah, no, we are continuing to support financing in, what we classify as specialized healthcare real estate sectors, the IRFs, the micro hospitals, and we are continuing to, deploy capital to those areas of the portfolio as well.
In construction, I mean, I don't want to take away, E.T., your
Oh, sure. On
perspective.
the more alt MOB assets, we do some inpatient rehab facilities. We're interested in the other assets in the context of a larger MOB portfolio. But we, for a one-off, one of most of them, I'm probably not your Huckleberry. Sounds like Winston and Steve feel a little better about them are able to get them done more than we are.
Construction is in the same vein.
Construction, I'm happy to admit it. Our largest value add for construction is size of transaction. So 100 to 200 million or north of that, we're probably a viable lending source. Inside of that, call Winston and Steve.
Thank you, my man. Thank you. We'll take it.
We'll take you out.
Okay.
Once it's built, we'll take you out.
Yeah, we'll do all the work and then you come take it.
Get you an equity recap.
Yeah, there we go.
Because those take no time whatsoever. Since we're talking about construction, we're often asked, and maybe I'll kick it over to John after I make my statement, but we're often asked, financing a construction project these days is not an inexpensive affair, right? With just where commodities and the replacement costs are. Before we ask Steve and Winston, we'll leave ET out of this one. John, what are you hearing? We're getting inundated with more and more construction requests. Mm-hmm. Obviously, there's a yield on cost conversation and an occupancy cost with the tenants. Why don't you tell the audience a little bit about what you're working on right now or here and talking?
Sure. Well, actually, good segue from your prior topic, but where we actually are most active on construction loan advisory right now is in the post-acute sector. On IRF specifically, it's been a really active area of our book. And so I think, there are certain operators in the IRF space that have ambitious growth trajectory ahead of them and plans to continue to grow through de novo construction projects. And there's a market for that opportunity, both from an equity and debt perspective. And so that's where we've spent a lot of our time on the construction side is build-to-suit IRF construction debt. I would say the market there feels pretty liquid. There's a lot of appetite, less so from the bigger institutional kind of money center banks, but more the specialty healthcare lenders, Steve and Winston, among some of the top market share participants in that regard. But we're seeing really good terms available, similar themes to what I alluded to earlier on just overall lending. Would tell you, LTC on construction very comfortably 70 to 75 now, where it was a little bit less comfortable a year or two ago. And, spreads for build-to-suit IRF, depending on the credit on the lease and the market and the sponsor, we saw those deals as high as, low 300s. Beginning of last year, and we've seen those spreads come down to kind of mid-twos on new build-to-suits with the opportunity for those spreads to burn down upon stabilization. So I think that's a function of a lot more competition and liquidity in the market. I will say there is still a hesitancy when people see some of the cost per pound and rents per foot that are coming out of these construction deals. So there really needs to be conviction around the operator, their ability to show stabilized rent coverages on a unit level, projection on these deals. Because it, for one reason or another, healthcare has continued to show very steady cost escalations, even where we've seen other sectors like multifamily level off. It's just a different level of construction, building the hospital standards in particular on the IRF side. So that is one challenge we're still navigating.
And I would say that the construction underwrite is definitely more complex. The spreads used to reward that for it, but to John's point, the spreads are getting somewhat compressed. But as you go through a construction budget, you're looking at the contingency items, you're looking, as far as labor costs and such as that, we have to really make sure that the budgets are built so to allow some flexibility. Yeah. So it's really not the ultimate tenant takeout credit. You want to make sure you're comfortable there, but really getting surety that you're going to get the construction done in a timely manner and the construction's going to work. There's going to be backup equity in place, completion guarantees. So it is a little more of an extensive underwrite, a little bit longer process. But I think it's definitely a high growth market. We're starting to see more and more opportunities.
One of the strategies we've tried to deploy to help borrowers get better construction debt for build-to-suits where we have borrowers taking more of a merchant build approach where they want to get in, stabilize and exit. we've been proactively trying to find takeout solutions through a forward takeout up front, and that really lends to more advantageous construction loan terms because the lender sees surety in their exit. It's very clear to them how the exit's going to play out, and if it's a credible capital source on the back end of that deal, we've seen that really materially impact for the better the terms available on the front end construction piece. So.
Yeah, and we're custom tailoring our construction product to what our sponsors need. So it's quite popular for someone with a build and hold strategy to want to do a mini perm situation. So we'll do a mini perm that we generally are going to cap out at 70% of cost, but then upon stabilization, a stabilization advance, and those terms can go anywhere from 5 to 7 years on a mini perm.
And I don't know if we touched on it, but one of the things obviously is in a multi-tenant format, if you've got a level of pre-leasing that's not going to be one for one in terms of how you look at it. Are we still a 1.0 on actual from a sizing perspective to hit the detachment point and the leverage? Is that a fair statement? Are you deviating from that and building in some interest reserve or an opportunity to upsize with additional pre-leasing through the construction effort?
We haven't done a whole lot of partially pre-leased. Everything that we're doing is going to be pre-leased. So that's not, I don't know, Winston, if that's a...
Yeah, we're seeing it. Yeah, a lot of stuff, Steve and I do some transactions together, but like Steve said, a lot of those have been single tenant. We are doing some multi-tenant. General rule of thumb, we like to see 75% pre-lease, ideally an anchor of 50% or greater. We will do some projects where there's a 20-30% anchor. If it's a large physician practice that has synergetic tenants that are coming in from a leasing perspective, we need to see kind of a solid pipeline. But to your point, Zach, it's probably a 1.1 cover, to go in to make sure, and you got to have a pretty good story of when that lease up's going to take. And sometimes we can do an upsizing, post construction as well, to cover some of the equity leverage up front. But I think overall, I would say probably about 75% of what we're seeing are single tenant transactions, and then occasionally you'll see a health system that will want to go in and do either an on or off campus multi-tenant, and they want to anchor some of the space and then bring in some other specialties.
And I know we talked a lot about IRFs. Behavioral is a big part of the conversation. How comfortable are we? I know there's varying flavors of behavioral, but maybe before I ask that question, one thing just came to mind. Construction dollars are valuable, right? And they're obviously risk rated differently than stabilized deals. You're probably getting more requests now than you had in the previous couple of years. Is the house view that you'll do more construction activity this year than you have conventionally?
I think we're going to see more opportunities. I don't know that we're definitely going to do that. I mean, the construction lending takes a lot of internal human resources, right? So we have to balance that within our own portfolio as to how many construction projects we can finance it at any one single time. So I don't think it's going to necessarily change our view, but I do believe there'll be more of an appetite for, we'll see more opportunities.
Yeah, I think we'll continue to see more, and I think we will execute on more. The spreads on some of the acquisition refis are still fairly narrow, so I think you're automatically almost forced to balance your portfolio and your returns. Yeah. We're a smaller shop, but we're staffed for it, and usually our underwriters that put the deal together end up following the deal all the way through. So a lot of our sponsors like that, because as Steve mentioned, these deals are a little bit more intensive from a hands-on perspective. So I think that's what they're looking for, is to take you all the way through the stabilization and the hopefully mini perm status.
It feels like the hospital buybacks or exercising ROFRs is almost a byproduct of this conversation in the cost of capital, right? So the auspice of buying maybe not a perfectly brand new building for $400 a foot or so versus building a brand new building or having a developer build you a building for $650. That math right now is playing out such that maybe it's going to stifle a little bit of the construction requests that are not 100% pre-leased by a credit institution.
Yeah, I mean, we can speak to that firsthand. We had 2 hospital ROFRs in the last 30 days, but coincidentally, both by health systems called University Health in totally different markets, but one in San Antonio, one in Cleveland. And these were true ROFR, not a backdoor ROFR from an investor saying, hey, buy it, we'll lease it, we'll do a sale leaseback for you later and pay a premium. This was truly to your point, Zach, hospitals saying, I need more space. The alternative is building for $650, $700 a foot, and I can buy this. And yeah, it's going to take me some time to get access to this space because there are third-party tenants, and I have to wait for those leases to mature. But if I can buy this for $350 a foot and get some cash flow off it, and be patient about my expansion as opposed to expanding day one, which they would have to be anyway if they were just starting construction today. That seems to be a good trade for the health systems right now. They are definitely cost focused. Construction costs are not an easy pitch to their board in terms of where to allocate dollars. So I expect the ROFR trend to continue this year.
Yeah. Couple that with the demand for more turnkey, more developer co-invested capital into these buildings, right? To the earlier point, occupancy cost is the direct result. You have to make a spread over the cost. So
yeah.
It'll be interesting to see. So I mentioned behavioral. I'd like to go back to that. I'd like to hear about behavioral. Any other subspecialties? You mentioned a few, but behavioral is a big part of the conversation, and I think.
And there's so many different flavors of behavioral. I mean, we are interested in pursuing opportunities with health system tenancy that specialize in behavioral. That said, that's a level of standard that we've set internally. So I know that others are doing freestanding, independent, de novo type behavioral health. That's not an area that we've delved into at this point.
We were selectively, I guess, active on behavioral last year. We did an eating disorder clinic of 5 assets that we sold to a net lease buyer. We did a financing for a inpatient behavioral hospital. Generally speaking, we're hearing a lot of kind of combining IRF and behavioral into this post-acute category, but I do think that's appropriate in certain instances, but in others a lot less so. And I think when you peel back to your point, there's a lot of different sort of subtypes of behavioral health, and where we're seeing investors and lenders behave fairly cautiously is where there's pen stroke risk, particularly on the Medicaid side, given current administration's position and some of the provisions in the Big Beautiful Bill right now. So I think there's a lot more favoritism in terms of reimbursement protection in favor of IRF and certain types of behavioral versus others. So I think we're seeing a clear preference towards a little bit more Medicare and private pay-centric areas of the behavioral health, and definitely a lot more caution around Medicaid-heavy payer businesses, because that's where I think there's perceived pen stroke risk.
Yeah, I think for us, behavioral has been a very small pocket. We've only done a few behavioral health transactions. I think it is starting to grow more in the market. I think we're probably waiting a little bit more to see some of the consolidation from the operating side. There's still a lot of requests to do some one-off smaller transactions for operators that we're not comfortable with. Occasionally you'll see a healthcare system that might be fully on. We're tending to see a little bit more multi-tenant deals with a behavioral health component.
Yeah.
Either a floor or a couple of suites. So I think it's a positive step. You're starting to see more of that. I think, to your point, there's the different, acuities within, behavioral health that people and the common folks are starting to understand a little bit better, and the insurance companies are starting to follow. So I think it might be a little bit different story, maybe a year from now, but right now we're pretty selective on what we look at.
I think for the standalone behavioral health for our part of the world, we have a lot of empathy for the need for the space, but we don't finance it. I think behavioral as a tenant we're happy to look at, and I think a behavioral facility in the mix of a largely medical office portfolio we're happy to take a look at. But on a standalone basis, that's not us.
Not you. Okay. We're getting a little bit low on time, so we're going to keep it maybe a couple more items. But John, you and I both, and we've talked about this a little bit, but there was a point in time a couple years ago where there was dark space risk, there was office risk, there was certain flavors, business plan deals that just weren't bank eligible. Right? It was a binary event where you may not have had a bank opportunity. Obviously, we could speak to it. I'd like to hear your thoughts on what you're guiding clients to right now. If it's credit-backed dark space, it's different than if it's unoccupied or obviously. But
Sure.
I'd like to hear what you're you're seeing in the marketplace?
Yeah, I generally think on a single asset, right? I think there's a very different view when you look at something across a large portfolio, where lenders get the benefit of cross-collateralized, cross-default diversification across multiple assets, multiple leases. But on a single asset, we would probably guide people to around a 10% threshold of dark space. If you've got more than that, I think you're going to significantly start to see terms impacted in terms of proceeds availability and pricing. And even at that, sub 10% dark space level, credit income gets treated a little bit differently in my experience, but lenders are generally not still giving credit to that NOI. So the deal has to size without it. So you take it out of your NOI projection and it still needs to cover whatever the standard is. For most, it's 1.25 as amortizing DSCR based on a stated rate, or if you're, lucky to get benefit for the hedge rate or credit for the hedge rate, that's generally how that sizing math works. When there's credit income involved, I do think there's some exceptions. We're seeing more of it in the health system world right now. There's a lot of planning to move into spaces. That gets treated differently than, I would say, just static dark space where a tenant has moved out and they've gone down the street and they're not coming back.
And maybe office, the office component in ET, I know you've done a little bit where there's been a component of office selectively for the right sponsorship. What's the house view on something that's mostly medical but has a little bit of office exposure?
With respect to both, I think they both have a similar dynamic. It just depends on the relative percentage. I think from the office standpoint, if it stays within 10%, we'll take a look at it. It also depends on what the tenant is, what they do, and if it's investment grade, how that plays out. With respect to the dark space, I think mitigants to it are, as John mentioned, credit. Right? If the rent's being paid and it's coming from a credit-rated entity or investment-grade entity, that's one thing. I think also health systems and hospitals, dark space may be treated a little differently because they may just be staging it for future growth. Yeah. But all that being said, the lower the percentage of both, the easier the transaction is, and at some point it'll start to impact the structure and the pricing.
So suffice to say, we're leading question, but we're not
5 to 10% of both.
Yeah, we're not probably in a market where you're converting office to medical.
We are not doing that under any circumstances. No,
not yet.
Nope. Well, again, get it converted, we'll take you out.
Do the hard work. We're consistent with Eric too. I mean, we'll look at a little bit non-medical in the space. Sometimes there's some retail on the first floor too. We'll look at that. From a dark space perspective, it's a lot of times what's the story. We've seen multiple deals where the hospital system has moved a specialty out. It's dark, but you still have a long-term lease. We've had others where they've moved out. So a lot of times too, you're just underwriting the sponsor. I mean, we've got some great sponsors out there. I know. One of our good friends on the med property side, for example, we had some space and they worked through it. And so I think a lot of it is just you need to be comfortable kind of where the strategy is and just really make sure that you're relating to the sponsor and what the plan is. So that's how we kind of underwrite it and look at it.
That handsome Tony Stark looking fellow there in the gray and black, is that who we're referring to?
There he is right there. Yeah, there he is. Okay, all right. I didn't even know he was here.
No, just making sure he heard you.
All right, good deal. There he is.
Steve, I'd like to hear from you on the subject.
Yeah, sure. Health systems are oftentimes warehousing some dark space. It's not going to be a majority of any project, and as Eric alluded to, the less that space is, the easier the deal is to get done, and it does, get reflected in the pricing. It's something that we do see in the marketplace.
I think one of the, one instance I recall, I think you brought this up, but some of your lending outside of an ET, multidisciplinary lending, how are you, as you're interfacing with your peers inside of your respective companies and institutions, what are you hearing in other asset classes? Is your credit team, is your portfolio managers saying, hey, we're doubling down on healthcare because, office or senior houses is taking away attention from the healthcare book at this point in time? What's the general sentiment relative to other asset classes?
Great question. So I can answer part of it. We are separate from the commercial real estate within my particular financial institution. We're part of the corporate bank, so we're a couple steps apart. So we're a corporate bank, and then we are part of the specialty corporate bank within the corporate bank. The commercial bank includes commercial real estate. So I don't have quite as much interplay with them, although our capital markets team and our risk team are both part of CRE. I think for what rolls up to me, which is healthcare REITs, medical office, and seniors, we're very bullish in both seniors and medical office. As it correlates to other asset classes, I'm embarrassed to say I kind of don't know. I'm not entirely sure. We kind of have our own P&L within the corporate bank P&L, so we're a couple steps removed from what commercial real estate's doing.
Zach, I could just add, just from a perspective, Siemens is a major global conglomerate, and we're all across the world, and the only real estate charter the organization has is for healthcare real estate in the United States. So that pretty much, I think, summarizes kind of what our view is of this market.
Yeah. So. We just need to bring that number, that $50 million cap up. That's the next order of business.
I know. I got the team here that we're constantly hammering that message through.
Yeah.
So
We're directing comments.
I keep telling them put a 1 in front of that 5. We're trying to get there. So.
Yeah, so I mean, our platform rolls up to our healthcare group. It is a lot of crossover with risk management and portfolio management with our traditional CRE team, but we have a specialized group that handles seniors, skilled SNFs. So that's outside of what I focus on.
And it doesn't sound like it impacts your business year to year.
I mean, we're very active in both sectors right now.
And I'll say for the CB side, and I'm sure, John, you have a similar experience, we see every quote that gets inked throughout the system.
Yep.
So some of the takeaways that we pay attention, maybe not Freddie and Fannie financing, but we pay attention to some of the other asset classes. And there's been a noticeable increase in leverage and decrease in spread in hotels, for example, and other asset classes, maybe disproportionate to what we've experienced since we've been fairly stable relative to the other real estate, uses in the universe. I'd love to hear, what are you hearing from your counterparts in your office? And
I think a couple things. One, seniors housing activity is very robust. Our seniors groups put a lot of debt in place. The team overall did about $35 billion last year. It's a massive growth engine for within healthcare, and so. It's hard to keep pace when you see those deal sizes, and you're also seeing we're the beneficiary of a lot of capital flooding out of office, but they are a significant beneficiary of capital chasing rent growth across multiple alternatives. So they see a lot of capital inflow, both debt and equity. I would say probably one other theme, because you mentioned office earlier. Office is still challenging, but New York City office is back in a big way. We've seen that pretty consistently in terms of Class A office, leasing momentum, capital markets activity. I don't think it means the people on this stage are tripping over themselves to have more of it in their book, but there's a market for it. And I've heard time and again, don't bet against New York City. Like it's proven to be true. It's a resilient place, and the office market's starting to show that sign again. So.
Yeah, and it's nice having alternatives other than the public market execution for a lot of other asset classes. And it balances out, our business, your businesses directly. I mean, the portfolio management on the credit side is equally as important as it is on the equity side. And if there's productivity and balance in those other asset classes, it's a good signal for your business and our businesses combined. So we've got about 20 minutes left. I thought we had an hour. I guess we have an hour and 15 minutes. If there's any other topics that are coming to mind that my panelists would want to bring up. Otherwise, we can open it up to some Q&A and see if we can't make it interesting for you. Yes, BJ.
I know you talked about this a little bit just a second ago, seniors housing, but could you, for those of you who are involved in new development of seniors housing, what those terms look like, and how much you've done of that over the last, say, year? I'd be curious to hear.
Since you're looking at me, very happy to respond, PJ. We have kind of the same construction precepts on senior housing, so I do not know. We typically do stabilized to take out type construction, or stabilized to take out acquisitions and refis. We do not do much in the way of construction. If we did, it'd be structured debt, and those terms aren't the same.
Yeah, we're not involved in the senior housing side ourselves either, so there's not a lot of, Siemens cross-sell opportunity. It's a different type of underwrite as well.
PJ, you can shoot me an email and I'll connect you with the right person at First Citizens. We are active. It's just not what I do.
I can't answer that as an expert, but I say the activity we see is a lot of local, regional, super regional banks, as you would imagine, with some credit enhancements to get things to a leverage point that make sense. The malaise, I think that part of the market felt through COVID and quite frankly, the pounding they took over that course of time, that year and a half, seems to have fully dissipated. And the permanent financing to the construction financing, there's deal activity throughout. My old partners at HFF are now with John and Newmark, and they're extremely productive, both on the investment sales and on the financing side. So I know it's a robust, but not our bailiwick up here. So.
Yeah, I'd be lying if I could tell you in-depth detail in terms, but definitely appears to be a really liquid and active market. So.
Thank you.
But it's important to note that, thematically, what we've been screaming for years is the designation to an alts category versus an office category, right? Which is why we all deliberately say medical outpatient at this point in our lives. And it's starting to really come to fruition relative to the equity investors and, the new entrants that John and I see and you all see as partners on the borrowing side are really a testament to that. They're raising enormous amounts of capital. And yes, we compete with data centers and senior housing and some other, self-storage and other niche, what we would call niche asset classes. There's definitely more emphasis in liquidity in the equities markets, which drives the attention. And I think that's what we experienced last year and we'll continue to experience this year with new joint venture partnerships, refreshed mandates, enhanced mandates. It feels like the liquidity is strong on both sides of the ledger, equity and debt. I think you all would agree.
Yeah, absolutely.
Yes, sir.
So question, if you watched CNN like a year, not CNN, CNBC a year, even 2 years ago, one of the big topics when the interest rates started going up was, geez, there's this 800-pound gorilla out there somewhere called this CR, commercial real estate wall of maturities, And, I'm hearing up here that it really hasn't been that much of an issue within healthcare real estate. But from a bank perspective, are we still working through that? Is that still an issue out there? Or are we just getting past this? Is it just has the NOI grown in all these sectors to the point where the maturities are not that much of a problem right now?
I said it earlier, and I continue to think we're going to see a lot of it this year. Think about 2021, the portfolio financings that were put in place. A lot of that was 5-year paper, 3-1-1s that are now up at their last extension or 5 years. Flat term, or maybe they had a 5-1-1 structure. I think right now for the next 3 years is where we're going to see more of that start to come due, and maybe it's another year of 1-year extensions. And there was a while in the market there where it's good business to do a 1-year extension for a nice 1-point fee and kick the can down the road. There is a limit to how much you can do that before you need to address, whether or not the takeout makes sense and the refi can pencil. I think what's helping that dynamic show less distress, while it is going to see a wall of maturities in the next 24, 36 months, there is, I think, interest rate relief. There's contractual NOI growth in our sector, not speculative. We're seeing that NOI growth improve every year. It's probably above 3% now on a net effective basis. I think those are going to make for a lot more easy maturities than what we would have seen if this wall of maturities happened in 23 and 24. So I do think we are still working through it, and I don't think there's a lack of distress. I do think there are going to be opportunistic transactions that come out of it, where there's just sponsors that don't want to put a cash in refi together, and they're going to have to deal with that with their lender. But for the most part, I think we're just starting to see early innings of that materialize.
Yeah, the headline news you're speaking of, you could find data points of, defaults, right? Maybe it's a valuation misalignment, right? Life science we can pick on. It's been a big part of my business historically. And the fact of the matter is there's very few trades that substantiate the values that these buildings even cost to build, right? And if you have office, maybe not in New York City right now, but you think about the evaporation of that equity, that's where I think the stress in the broader capital markets is really being felt right now. Our industry, not that we haven't had distressed sales in situations, but fairly well insulated for the reasons that John mentioned, the above 3% average rent growth. I think as a market, it seems to, we've become more rational with contractual rent bumps that no longer stuck in the mid to upper ones. Now there's a good acceptance in the marketplace of additional 2 to 3%, if not more, in rent growth. So time does heal a lot of problems. Talking about going from 65 to 70, where we were kind of squarely at 75, we're not too far away from that. And every year that goes by, and extensions are not unlimited, but that does create a better environment for us relative to other asset classes, for sure. And what's interesting too, for whatever it's worth, having conversations within my shop with folks that focus on retail and hospitality, for example, I think what we recognize there is those asset classes adjusted fairly quickly to the market shift and just kind of accepted reality. And it's no longer, it's now a 7.5% interest rate environment for retail. Okay, cap rates went up, cost of capital is what it is, and a lot of the folks that are in my office and focus on retail and other asset classes like that, they kind of came to reality a little bit quicker. I think we were also, enjoying 2 and 3% interest rates and 4 caps for a long period of time, and most certainly there's a lot of time that needs to go by for that to right size, to not be an issue. But it feels like there's been liquidity in the marketplace. There's been like we closed a construction loan for a pre-IPO diagnostics company last year at a very expensive rate, but it was a 72% construction loan for $105 million. So it got done. Point is, there's opportunity to do those. It's just cost of capital. Any other brave victims out there?
Anybody else? What do you got?
Should we ask ET about the odds on the big game next week? What are we looking at, the money line?
JSN for the MVP, plus 2,200 on DraftKings. Go get him.
So my question is, through the lens of capital markets, when trying to evaluate a healthcare system, kind of, what are the other drivers that really play into it, just besides like a credit and cash flow?
Well, I think we've got some pretty smart people on the stage that can talk about how they evaluate risk. I think one of the things, I, as an intermediary, look for are, payer mix. Where do they operate? Are they exposed to a lot of Medicaid in their health system? That right now is, I think, a focal point of capital, just in terms of, like I said earlier, some of the provisions in new legislation that could really impact health system margins, which are already pretty strained. So those are some of the things. I think credit, cuspier, BBB, right on the cusp of investment grade credit. Not all those credits are created equal. I think size matters in particular when you look at some of the kind of cuspier credit ratings. I think it becomes maybe a little bit less of a focal point when you're kind of AA or better. But when you're in that cuspy on the verge of investment grade, we've seen a clear signaling from, in particular, the lender community, in our experience, that they look for more scale and size, diversity of operations, geographic footprint, et cetera.
And I'm going to lead the witness because we were just talking about this. I mean, I think the beauty about the experts up here are that they spend a lot of time thinking about not just credit ratings, but other aspects of market dominance and market positioning. And so, Steve, the situation we were just talking about was a non-credit rated, pretty low credit rated institution that you got comfortable with. And I'd love to tee you up for that one.
Sure. Yeah. I mean, we're going to be looking very focused on the region, the local environment, and the performance of the actual asset. Now, it may be that the system is nominally underperforming, but the asset is significantly overperforming. So we have definitely gotten comfortable in those situations. We're really looking at, what's going to generate the NOI that's going to repay the debt.
Yeah, I think that.
Don't send Steve all of your non-investment grade.
I think underwriting to the actual hospital level is critical, particularly when you're talking about, I'll pick on CHS as an example. They're for-profit, they're large, their credit rating on the surface is not one that we see a lot of institutions tripping over themselves to get access to, but there are winners and losers in any portfolio, for-profit or otherwise. There are certain hospital systems within the CHS umbrella that on their own would shadow rate to investment grade. And so if you look that, level of diligence further, you get pretty comfortable if the parent, goes away, you've got an ability to predict either a strategic buyer to come in or that health system standing alone on its own and operating profitably and with good credit metrics. So I think particularly that's important when you're looking at, credit tendency in those categories, but also on-campus assets next to hospitals like that. Underwriting to the hospital level becomes critically important.
Yeah, I think John hit a lot of the factors there. I mean, from a Siemens perspective, we're in 99.9% of all hospitals nationwide. We sell, as most of you know, imaging equipment and lab services and all types of IT services out in the market. So we've got a long history of financing hospitals, and I think a lot of it comes down to experience. A lot of our underwriters have been through all the cycles. So obviously you have the public bond rating agencies that are out there as a guidance. But again, to John's point too, we see a lot of systems that may be struggling, but the independent, local community hospital may be doing well. So again, it just depends upon the bank and how they underwrite that. If they have to default to the parent rating, or if they can take into account the actual operation of the asset that you're looking to acquire or to finance. So I can't underemphasize the key of experience, because there's so many nuances to a hospital operation. Having access to the C-level and really understand that is where we get our comfort zone from.
I think for our part of the world, we have an investment research group that can give us really detailed information that we can really rely on for actual diligence and underwriting. I think from a 30,000 square foot just sizing an initial loan, what these guys said was pretty accurate. You look at the rating first, and I really look at size. I think John's exactly right. The size of it, how many hospitals, all that really makes sense in terms of considering the viability. And then I also agree with Steve, if you're looking at a tenant, it really just has to be a going concern, right? It doesn't have to knock the cover off. It just has to pay rent to get your NOI that pays your debt service. So, from a higher end look, in order, rating, size, and then the relative likelihood it remains a going concern through your loan term for a tenancy. And then on a more detailed diligence and underwriting analysis perspective, we just use our investment research group.
And that really plays into, if it's a non-investment grade tenant that's a de novo location, it's obviously riskier, right? So you think about some of the conversation earlier relative to IRFs and your all familiarity with the operators and strength of the operators, it's still, if it's not the strongest balance sheet and it's a de novo facility, that's a lot harder today. And if it doesn't have those credit enhancements and rent guarantees or corporate guarantees, it's still a pretty fragile environment. But if you have 4-wall operations and you're performing at a strong multiple on coverage and rent coverage, those are the stories that we often lean on to figure it out.
Zach, I was just going to add one thing. Just it's not directly the acute care hospitals, but there's a lot of activity ongoing now for physician-owned surgical hospitals. They're looking to now partner up with major healthcare systems. So we've seen numerous transactions over the last 12, 24 months where the physicians are selling out the OpCo and then selling out the PropCo, taking some of the distributions, but still providing cases. Steve and I did a fairly large one down in Houston, which is a prime example. Now that they've gotten 51% ownership or greater from the hospital system, they're getting much better payer contracts. So you're starting to see a lot more activity potentially on the real estate front with the movement of that properties there. So.
Is that going to do it? Anyone else? Nope, good. All right,
Awesome.
well.
Thanks, everybody.
Thank you all very much.
Thank you.
Have a good afternoon.